Let's talk about the Fed meeting. We're coming up Wednesday. What predictions you got? What are you expecting out of the central bank when Powell speaks at 2:30 Wednesday?
25 basis point hike, Garrett. I can't see 50. I mean, I know there's been some talk lately that financial conditions have loosened enough where the message might be 50 to shake market participants up a little bit. I don't see that happening for one reason. The range right now on Fed funds, the target range is 450 to 475. But that was right now it's 425 to 450. So a 25 basis point hike would be 450 to 475. That's the range. Right now, and for the last more than a month, the effective rate, the actual overnight transactions cost of money in the Fed funds market is 4.33%. It's been that way. It's not going high. It's nowhere near the 450 level. If they raise 25 basis points, it's probably going to stay around 433, maybe go to 440. It's not even going to get to 450 on the lower end. So if they try to go 50 basis points, the market's going to go, Fed funds are trading way down here. No one's paying attention to what the Fed's doing. Then there goes their credibility. The only way they can move the Fed funds rate up there is actually by going and doing open market operations and moving it there. And they're not ready to do that yet. So 25 basis points, I think that's the show right now. And I think markets probably have that baked in.
I agree with you. The CME group has it at about 97% right now. And actually, there is no one betting on a 50 basis point hike. Actually, people are betting on no hike, which is a little dangerous, but it is what it is. So let's talk about February. February is, I think, the second worst month for the markets in the last 18 months in this kind of Fed-driven environment. What are you expecting for February, kind of given the fact that the GDP number was solid on the upside, the 2.9, but when you look at housing and durable goods, it was really, really weak. What are your expectations for the month ahead?
I think February is going to be volatile. I mean, you were talking about that earlier. Let's just roll back to January. This is the best January for the NASDAQ 100 since, are you ready?
Yeah.
1999, the best start of the year since 1999. Now, I don't see that because everyone's fighting the Fed. The Fed's going to continue to raise, in my opinion, at least 2 more hikes, probably pause after that, but everyone's front running the Fed. I think February is going to be very volatile. Also, the January effect, is seasonal. I think we saw a short covering there. We saw a lot of selling in December. Then we had the January effect, people getting back into the market, short covering, moving things higher. And here we go. We had a great January. Now what? Now the earnings are being knocked down. Analysts are starting to cut their forward earnings. I think the market's going to have some come to Jesus moment where it's like, well, wait a second. How are we valuing this? Right now, the S&P is valued about 18x. On a forward basis, maybe 16.5 if you believe analysts' cuts. So right now at 18, it's overvalued. I think there's going to be a lot of revaluation, re-rating in February. I think it's going to be a very volatile month and it's a great opportunity to buy puts. They're cheap right now.
Yeah, so Shot brings up a really good point, everybody. So the S&P 500 going up around 6.5% since the start of the year. We had that positive momentum switch on January 6th. What are people buying? I think that's the key thing, because if you look at the P ratio of the S&P 500, 20 was the start of the month. Now we're at 21.5. People are willing to pay more money for the same earnings. And what Shah is saying is that earnings expectations are going to be cut. So what are the stocks that you're looking at heading into February as, this market could potentially shift from these kind of top levels that we've been seeing, strongest momentum that we've seen since August 15th. You can look at the chart and see what happened after that, everybody.
We're trading very short term, and as far as personally, I'm just putting stops. I have nice gains. I'm just raising my trailing stops and everything, because if we get a puke in February or March, which I think is entirely possible, this is battle royale going right now. You addressed it, but I'm going to put it in different terms. You have the fear of missing out crowd that is going to jump into the market if we go much higher, and you got the other crowd is saying, everybody's fading the Fed here, and they shouldn't be doing that, and the market needs to be re-rated in terms of valuation. We're at this crazy point right now. The one thing I'll say is if you think the market is overbought, you think we have a turnaround coming, right now put protection is dirt cheap. And it's a cheap way to play if you think we're going to get any kind of a pullback.
Shah, I believe that the next 2 to 3 days is an opportunity to take profits from this rally. Are you making bets ahead of the Fed? Because I'm just not willing to. I don't need to do it. I'm a reactive type of person. But if you are going to make a move, how would you do it? Would you look it to the downside, or are you looking to the upside?
I think if you're going to make a move, you got to really just be prepared to make the move after the market starts to move and jump in as quick as you can. And the smartest, easiest way to play that is with options on, let's say, the Qs or the SPY or the SPX itself. And again, this is where Kenny's going to come into play because really following the volume weighted average price on whether it's a stock or on the market is going to be telling you can make quick moves and make quick money on that. As far as taking longer term positions right now, that's a difficult play right now.